Wall Street runs on numbers, but numbers can lie. Not with words, not with smoke, but with precision, spreadsheets, and a quiet twist of an accounting rule. These lies don't shout, they whisper, and by the time you hear them, the truth is already buried in the footnotes. Earnings management isn't outright fraud. Think of it as bending the rules without breaking them, using the flexibility in accounting standards to make a company look just a little healthier, just a little more profitable, or just a little more stable than it really is. The practice can sway investors, influence stock prices, and even impact executive bonuses. As Catherine Skipper first defined it, it's about deliberately shaping financial results within the boundaries of accounting rules to achieve a goal, whether that's boosting market confidence, meeting debt covenants, or hitting those all-important analyst forecasts. There are two big playbooks for earnings management. The first one is accrual-based earnings management, while the other one is real activities manipulation. Accrual-based earnings management happens after the financial year ends, adjusting accounting estimates like depreciation schedules or warranty provisions. For example, stretching the useful life of a building from 10 to 15 years lowers the annual expense, and suddenly profits look stronger. Real activities manipulation. This happens during the year, and it changes actual business decisions. Management might cut R&D spending, delay maintenance, or even overproduce goods to lower reported costs. It's considered a softer form of manipulation, but it can still change the numbers in a big way. Motives vary, but they often fall into three buckets: contractual obligations, such as meeting loan covenant or other arrangements tied to reported earnings, and lastly, influencing outsiders, such as shaping perceptions for regulators, competitors, or potential acquirers. And here's the catch: even when these tactics sacrifice long-term value, executives may still use them to dodge short-term market backlash. Enron. On paper, it was America's most innovative energy company, trading electricity like stocks, promising endless growth. In reality, a house of cards built on special purpose entities, off-the-books shell companies that hid billions in debt. Picture this: executives moving debt around like shells in a street game, so the balance sheet looked pristine. Investors saw stability. In truth, the company was bleeding cash. They used something called special purpose entities, SPEs for short, to sell underperforming assets to companies they secretly controlled. The sale was recorded as profit, and the debt tied to the asset was moved off Enron's books, even though Enron still bore the risk. They also exploited something called mark-to-market accounting, which means booking the full projected profits of a contract on day one, even if the money wouldn't arrive for years, or might never arrive at all. When the reality fell short, they shifted a loss to an SPE, which, keep in mind, they control themselves, only to keep quarterly numbers clean. When the truth came out in 2001, Enron's 63 billion market value evaporated in weeks. Thousands lost their jobs, pensions, and life savings. WorldCom, the telecom giant, had a different trick: capitalizing expenses. Imagine you buy office supplies, but instead of marking them as costs, you claim they're investments that will pay off over years. WorldCom did this with billions in line rental fees, making their profits look enormous. Instead of recording those fees as operating expenses, they moved them to the balance sheet as capital expenditures, spreading the cost over years. This kept them off the income statement, and in turn inflated the profits. When the SEC pulled the thread, 11 billion in fake profits unraveled. It was, at the time, the largest accounting fraud in US history, and their CEO, Bernie Ebbers, went to prison for 25 years. These weren't just adjustments, they were precision-engineered illusions, crafted by some of the smartest accountants in the business, and they worked, until they didn't. Fast forward to today, and the game is even bigger, faster, and more connected. The S&P 500 is trading at an all-time high. Bitcoin and Ethereum are running like bulls, breaking resistance levels like they're made of glass. Artificial intelligence stocks, from chip makers to startups you've never heard of, are exploding because the world thinks AI will change everything. And it just might. Meanwhile, the war in Ukraine is reshaping energy markets in real time. Oil spikes, gas prices swing, defense stocks rally, grain exports stall. What happens in a Black Sea port can move the price of bread in Paris and the price of wheat in Chicago. But here's the twist. In a world this interconnected, earnings management isn't just an accounting choice. It's a market force. When a tech giant smooths its revenue numbers to keep Wall Street happy, that decision can ripple into index funds, 401ks, housing markets, and even small businesses halfway across the world. Sometimes it's deliberate, sometimes it's just playing by the rules, a little too creatively. But in a hyper-connected economy, a slight tweak in a spreadsheet can spark a butterfly effect, shifting investor sentiment, altering capital flows, and, in the most extreme of cases, rewriting the economic story for millions. Earnings management doesn't just change how a company looks on paper. In the right moment, under the right conditions and circumstances, it can change the world. Earnings management thrives where there's an information gap, when managers know more than investors. This imbalance can inflate valuations for companies that manage their numbers, while honest firms might get overlooked. It's a classic market for lemons problem. The best apples and the bad apples are in the same basket, and you can't tell them apart. Spotting the signs. Researchers use models, like the Jones model and its later modifications, to detect unusual accruals that might signal manipulation. But for everyday investors, spotting it is tough. The key is to look for red flags, sudden shifts in accounting policies, big one-off items, unusual timing of expenses, or revenue jumps that seem disconnected from the business fundamentals. Earnings management doesn't always mean a company is in trouble, but it does mean the story in the numbers may not be the whole truth. In finance, as in life, it pays to read between the lines. Back in 1991, Jennifer Jones gave the academic world a simple but powerful tool to sniff out earnings management, the Jones model, and here's how it works. First, it assumes that some accruals, adjustments in accounting numbers, are normal because they're driven by real business changes, like growth in sales or shifts in fixed assets. The model builds a baseline for these normal accruals using historical data. Then it compares that baseline to the company's actual reported accruals. If there's a big unexplained gap, so-called discretionary accruals, it's a red flag that managers may have massaged the numbers. Over time, researchers realized companies could game the original model. Modified Jones model 1995 excludes the effect of changes in credit sales to reduce false positives. Then we have the performance-matched models, comparing firms to peers with similar financial performance to control for economic conditions. Then we also have models like the Kothari model, which adds return on assets as a control variable, making it harder for high-growth firms to appear suspicious just because they're growing fast. But these models and variants are not foolproof. A clever CFO can still beat the model, but in forensic accounting, it's like a metal detector. It won't find every coin, but it will tell you where to start digging.